Well, good morning, everybody, and welcome. I'm Paul Johnson, Director of the Institute for Fiscal Studies, and I'm delighted to welcome you to this event where we'll be looking at the temporary benefit increases that have been put in place this year by the government at the cost of something like £9 billion. In most years, that would be really big news. This year, with everything else that's been going on, it's got probably rather less attention than it's deserved. The government has said that these will be temporary as we go through the crisis of this year, but that really raises questions as to whether they will really be cutting benefits again, particularly at the end of this financial year, leaving a lot of people a lot worse off, and also what opportunities for reform that this presents us with if we're looking at universal credit and local housing allowance. To look at that, we have published a substantial report coming out today, which is part of our Green Budget, which will be published on Tuesday next week. Today, one of the authors of that report, Pascal Bourquin, will be presenting for 15 minutes or so, taking you through our findings. We're then delighted to have Stephen Timms, who is chair of the Work and Pension Select Committee, someone I worked with when he was a minister in the Treasury, actually more than a decade and a half ago. So Stephen also has experience as a minister both in Treasury and in DWP. We will then have hopefully 20 or 25 minutes for questions, when we'll be joined also by Tom Waters, one of the other authors of this report. If you have questions, please do put them into the Slido app, which you should all have a connection to, and I will field those and send them on either to Stephen or to Tom and Pascal as authors of the report. But with no further ado, let me introduce Pascal, who will spend 15 minutes or so taking you through the main findings of this work.
Thanks, Paul. So, in the wake of the coronavirus pandemic, the government introduced a wide range of new measures to support personal incomes. The most prominent one was perhaps the furlough scheme. However, they also introduced temporary benefit increases related to already existing parts of the working age social security system. And in this presentation, I'll be focusing on those measures. So this figure here shows you real working age benefit spending over the last 2 decades or so. Note that the dotted line actually is forecasted spending. So even ignoring the temporary benefit increases, we see a large 25 billion increase in forecasted real-term spending over the last year. And this is due to the increase in the number of families claiming working age benefits, as well as increased entitlements among existing claimants. The triangle here then denotes the additional 9 billion increase in working age benefit spending due to the temporary benefit measure increases. So working age benefits expenditure is now forecast to be 7% of national income, and easily the highest since records began in the late 70s. So this is the central scenario, and maybe too pessimistic, but even on the upside scenario, spending is still easily the highest ever. So in this presentation, I'll be focusing on 3 main temporary benefit increases. So the first is the increase in UC entitlements by £1,000 per year. The second is the suspension of the minimum income floor, which prior to the crisis reduced UC entitlements among low-income self-employed. And the last is the increase in the maximum support for rent for private renters. So under current plans, the measures are set to be in place until November to March 2020. And some of these temporary benefit measures actually connect to areas of the system that were ripe for reform even prior to the crisis. So I'm now going to take you through the first temporary benefit measure, the increase in the standard allowance of UC. But it's first useful for you just to know how universal credit works. So here I'm going to show you benefit entitlements for 2 example families. a lone renting parent with one child, and a single owner occupier without any children. Now, just to note, these are both out of work families, and as families actually move into work in broad terms, the more they earn, the lower their entitlement. So for these families here now, first there's a basic element, which basically just depends on whether you're single or not. If you have children, you then get an additional amount depending on the number of children that you have. And if you're a renter, you get an additional amount to pay for rent. So before the crisis, this was basically the amount of UC that such an example family would get. In March 2020, however, the government announced an £87 per month increase in UC. Now, clearly this temporary expansion was a much larger proportional increase for families with lower entitlements to begin with. So those without children, owner occupiers, such as the example family here on the right. Furthermore, the temporary increase also has a particularly large proportional effect on out of work families. So with that in mind, let's look at how out of work support has changed over time. So here I'm showing you out of work support over the last 4 decades or so. And what we see is that there's really been a little real increase in benefits for single and couples without children over this 45 or so year period. For families with children, however, as you see, there was a big increase in the late 90s, early 2000s due to the expansion of the tax credit system. So out of work benefits for families with kids have basically roughly grown in line with average earnings. However, out of work support for families without kids has really become less generous as a share of average earnings over time. So again, this is what it looked like before the crisis. Now let's add in the temporary benefit measures. What we see is that for a childless family, the temporary £20 per week increase in benefits is really larger than the change in out of work benefits over the entirety of the 45 year period that I'm showing here. And for those with kids, it's a bit less significant. But overall, as we show in our report, the UK system of support for out of work claimants is really quite thin by international standards. And the temporary giveaway only really makes a minor difference in this respect. So what are the options for UC beyond 2020? Well, broadly in the short term, we think that there is a strong case for linking future policy plans to the recovery. If the labour market continues to be weak, we're less concerned with the fact that increasing the standard allowance weakens the incentives for families to have someone in work. So the government may therefore want to extend the temporary increase in the standard UC allowance beyond the current financial year. But either way, it's going to be important to announce a potential end of the temporary increase in the UC standard allowance early. And this is because around 4 million families will see their entitlement drop by 13% on average from 1 month to the next come April 2021. So longer term, they could also make the change permanent. And this would boost the incomes of the poorest households. However, it would weaken incentives for families to have someone in work. Alternatively, if the government's kind of minded to make the 6.6 annual cost of the UC standard allowance increase permanent, it could also spend it on something else. So we estimate that the government could actually raise UC work allowances, so the amount you can earn before your UC amount is withdrawn, by around £86 per week, also for a 6.6 billion annual cost. Alternatively, it could also reduce the taper rate, so that's the speed at which your entitlement is withdrawn as you earn more, by 22 percentage points. So as I said, both would cost 6.6 billion per year, and both these policy changes would strengthen work incentives. However, evidently these wouldn't benefit out of work families. So let's move on to the second temporary benefit increase, the minimum income floor suspension. Okay, so in UC, self-employed individuals can be subject to a minimum income floor, or the MIF. And the way it works is basically that if you earn less than what an employee earns at the full-time minimum wage, so what the MIF is equal to, then you're treated the same as if you did earn that amount. It therefore reduces the maximum amount of entitlements self-employed individuals can get. So the MIF is actually only applied once you've been self-employed for a year. And this grace or so-called startup period basically has the purpose of allowing self-employed to get a business up and running. Now, there are three main purposes of the MIF. So firstly, it disincentivizes fraudulently underreporting earnings, which is easier for self-employed to do as compared to employees. And secondly, it disincentivizes being self-employed to avoid job search requirements. So what do I mean by this? Basically, if you're out of work, the government typically conditions you getting benefits on you actively searching for work, but this isn't the case for the self-employed. And lastly, the MIF avoids the government subsidising non-viable self-employment. Now, at the onset of the crisis, the government actually suspended the MIF, and under current plans, it will be reintroduced on the 13th of November. So let's look at who is affected by the MIF by looking at the earnings of the self-employed. So what I'm showing you here on the vertical axis is the percent of the self-employed that earn different amounts per week. The black arrow shows you what the MIF would have been had it not been temporarily suspended. And what we see is that a really large proportion, around 43% of the self-employed earn below the MIF. And that number raises to 64% if we just take those on means tested benefits. Now, not all of these people actually have the MIF applied, perhaps because they're not on UC or they have a high earning partner, which may mean the MIF isn't applied to them. But this just basically gives us a flavour of how the MIF relates to self-employed earnings. So in general, there are two main objections one may have against the MIF. So the first pertains to the startup period. You might just think that one year really isn't enough to get a business up and going. So let's look at whether that's the case. So what I'm doing here now is I'm taking all self-employed individuals in the first year of self-employment who were on means tested benefits in that year. And I'm looking at what proportion earns below the MIF. In the year that they become self-employed, around 2/3 of them earn below the MIF. Now, 1 year later, of those that have remained self-employed, the proportion that earn below the MIF actually is still around 2/3, so same as before. And the same is true for the second and third years after entering self-employment. So broadly, there really doesn't seem to be evidence that by having just a 1 year startup period, the MIF is choking off what would turn out to be a high earning business. So a second key objection of the MIF is that it causes problems for volatile earnings because it's applied each month, and that's even if annual earnings are greater than the MIF. So what does this mean? Well, basically, in low earning months, the MIF is then applied and your UC entitlement is reduced. And in high earning months, the MIF isn't applied, but you don't get any compensation for earlier losses. So what are the options for reforms, keeping in mind the facts that I've just shown? So one obvious option is to abolish the MIF permanently, which would cost around 1.4 billion per year. Now, this would increase the incomes for the poorest households, and households affected by the MIF would see their average income rise by around 25%. However, this does also mean that we would lose the benefits of the MIF that I mentioned right at the start. So for example, its anti-fraud function. Now, another option would be to increase the startup period. However, as I showed you before, it just doesn't seem like those affected by the MIF are continuing on to grow their businesses beyond the first year. Lastly, you could use a 12-month rolling average of earnings instead of monthly earnings to determine whether the MIF applies or not. Additionally, you could basically steadily increase the MIF level from 0 to the full amount after the startup period. And this would treat those with volatile earnings in a more similar manner to those with steady incomes. It would also avoid a cliff edge in benefit entitlements 1 month to the next after the end of the startup period. So the government should really consider a reform along these lines. So let's look at the third temporary benefit increase, and that's one pertaining to housing benefits. If you're a low earning renter, the amount of housing benefit that you can get, or the housing entitlement component in UC, is capped by your local housing allowance, or your LHA rate. And LHA rates vary across the country and with household size. So back in 2012, LHA rates were at the 30th percentile of your local rents. But since then, there's been various policy changes, and this includes freezing the LHA rates, uprating them by 1%, or uprating them by CPI. And the consequence of this is that the maximum support for housing you could get is basically linked to 2011 rents and not current rents. And this especially reduces the amount you can get in high rent growth areas. So let me demonstrate this with this graph. What I'm showing you here on the vertical axis are the LHA rates that would have been in place in 2020 had there been no temporary increase. And the horizontal axis then shows you the 30th percentile of rents. The diagonal, the 45-degree line, shows you where LHA rates would be if they were set to the 30th percentile. But so because the government delinked the rates, the picture actually looks like this. As you can see, all LHA rates are below the 45-degree line, so all get less housing support than the 30th percentile. However, what you also see is that not all are treated equally. So let me just pick out two examples here. For example, in Cherwell Valley, the maximum amount of housing benefit you can get is £197. So you can nearly, and that's per week, sorry, and you can nearly afford the 30th percentile of rent. However, in Cambridge, where local rent is actually higher, the maximum amount you can get is actually lower at £182. So basically, delinking LHA rates has hurt those in areas that have seen the fastest rent growth the most. And in general, it's just really odd that higher rent areas are getting less support than lower rent areas. So the temporary benefit increase announced in March 2020 is actually setting the LHA rates back to the 30th percentile with no official plans for 2021. However, the Secretary of State for Department for Work and Pensions has suggested they may make the change permanent. So what are the longer term options for reform? Well, firstly, we could just return to the pre-COVID system. However, as we've just shown, this causes an inequity due to some higher rent areas actually receiving less than lower rent areas. An alternative option would be one could also just stay at the 30th percentile of 2019 rents and continue with pre-crisis rules for indexation. However, this again just really resets the clock on the unfairness and unreasonableness of the pre-COVID system. And this is because come April 2021, LHA rates would just be uprated with CPI again, which would basically cause LHA rates to drift away from rents again. So a third option is that we could link to the 30th percentile, which avoids this fairness. However, of course, this would cost the government more, specifically around 1.1 billion in the first year. Alternatively, it could link LHA rates to a lower percentile without increasing the amount it spends on HB in the short term. So we find that linking the LHA rates to the 20th percentile does exactly this. So it costs the same as option one in the short term, and at the same time, it rationalizes the system. However, it's worth noting it does cause both winners and losers, with especially high rent growth areas winning. So let me summarize what I've spoken about today. The government could use this opportunity to reset the welfare system at a more generous level. However, in the case of the increase in the standard allowance of UC, the government really faces a standard trade-off between boosting the incomes of poorer families at the expense of higher costs and weakening work incentives. In the latter two cases, however, the government could really use this opportunity to rationalise two parts of the system that were really already ripe for reform prior to the onset of the crisis. And that's regardless of what we think the size of the system should be. So the myth could be made more robust to volatile incomes, and one could also avoid the cliff edge in entitlement it creates after the startup period. In terms of housing benefits, LHA rates could be linked to current rents rather than 2011 rents to avoid the inequity caused by rents growing to different extents in different areas. And such reforms are really very, very valuable regardless of the overall size of the system. Okay, thanks. So that's actually all from me. I'm now going to hand over to Stephen Timms, who will give some comments on the research I've just presented. Thank you.
Well, Pascal and Paul, thank you very much thank you for paying this attention to, for me, very interesting subject, and for the helpful analysis you provided, and thank you for giving me the chance to comment. I am one of those who'd like to see the opportunity taken to quote Pascal, to reset the welfare system at a more generous level. I've watched the food banks in my constituency shoulder an immense burden over the last 6 months. It's been profoundly impressive. Last week I visited the charity Fair Share, which collects surplus food from farms and supermarkets and other places in the supply chain and hands them on to food banks and other charities. And they told me that before the pandemic, they were sending 1 ton of food per week into the borough of Newham, which I represent in Parliament. And at the moment, they're sending 20 tons of food a week into the borough. And I think the pandemic has exposed the fact that we don't really have an effective social security system. We're not offering security to people. And I don't think that all the admirable and impressive volunteers who've been shouldering this over the last 6 months should be expected to do so into the future as well. One of the problems with the system is the 5-week wait for universal credit. After applying, you have to wait 5 weeks for your first regular benefit payment. You can get an advance earlier than that if you need it, but that 5-week delay is causing a lot of problems, and my committee, the Work and Pension Select Committee, will be producing its report on that subject specifically in the next couple of weeks. But to take the 3 measures that Pascal has looked at in turn, the £20 a week increase in universal credit, I'd like to see that stay. A lot of this very large number of people who've applied for universal credit for the first time as a result of the pandemic have been shocked to discover how little they have received in income, and that's with the £20 a week increase in place. My sense is that the view across the cross-party view in my select committee is that £20 a week increase ought to stay in place as well. Certainly, it would be indefensible to remove it when planned in April, when, as we now know, the pandemic will still be with us. So I asked the Secretary of State last week when she came to the Select Committee about this. I put it to her, it would be inconceivable to remove it while the pandemic was still going. And she said in her reply something like that her department is having active discussions with the Treasury about this subject, which I presume means that DWP would like to keep the £20 in place, but the Treasury is yet to be convinced. I asked the Prime Minister about it day before yesterday at Prime Minister's Questions. He said that, well, we keep these things under review. So we'll see where we get to. My sense is that it's unlikely the government would decide to take away the £20 a week increase in April. And if they don't take it away in April, then I think it would be quite difficult to take it away after that. It would be a big moment at which the government chose to drastically reduce the income of the least well-off people in society. So I think that will be difficult. We'll see where we get. The minimum income floor, this feature of universal credit is very different from how things worked in tax credits. Tax credits were very strongly supportive of self-employment. Universal, coming out of the DWP stable, is from a standpoint of much greater suspicion of what these allegedly self-employed people are actually up to. I am not myself convinced that level of skepticism is appropriate. I think tax credits support for self-employment actually over time brought about some helpful and beneficial changes in the labour market and a big increase in the number of people who were self-employed. And it seemed to me that most of them were genuinely self-employed in the way that everybody would hope. The government website says that the minimum income floor has been suspended, quote, for the duration of the pandemic. But as Pascal said, as things stand in the regulations, it will be reimposed next month. I can't see that could be justified in the current circumstances. The suspension of the minimum income floor does increase the incomes for the poorest, as Pascal has said, and the proposal that she's described for longer term reform with a rolling calculation looks to me like an interesting one. Lastly, on local housing allowance, the Secretary of State did tell my committee on the 30th of September, and Pascal hinted at this, and I quote, "The substantial increase in LHA, which is permanent, will have helped a lot of people around the country." That was question 212 in the transcript of that meeting. So it does seem to be the government's position. It is not going to be removed in April. It's not a temporary change. As Pascal said, that's particularly helpful to claimants in London, for example, those in my constituency. But the big increase in LHA plus the increase in universal credit does mean a big increase in high rent areas like mine in the number of people hit by the benefit cap, because the cap level has not been changed at all for the pandemic. The DWP initially told my committee it expected only a small number of people to be newly affected by the cap. In fact, the number of people newly affected, number of people affected by the cap has doubled from round about 40,000 to round about 80,000. The department says, oh, it's only gone up from 1% to 2% of all claimants. But of course, in London, the proportion is much greater. It clearly is right to link LHA with actual rents rather than rents as they were a decade ago. I think the government needs to look at the level of the cap as well. Much of the problem with people being newly capped is then picked up by discretionary housing payments. So it's not really a saving. The government has to spend more on the DHP part of the equation. But it's, I think, a really interesting analysis that you presented this morning. And I certainly hope that the opportunity will be taken to set the social security system at the higher level that we've experienced during this pandemic, and that we don't go back to the position as it was before.
Thank you very much indeed, Stephen. Thank you, Pascal. A lot to chew on there. I think it's very striking, some of the numbers that Pascal presented, how this has taken, the pandemic has taken spending on working age welfare to record levels in the UK, despite a decade of really quite significant cuts. The scale of increase, particularly for those out of work without children after 50 years without really any increase at all, has been extraordinary. And I think some of those charts that Tom and Pascal drew showing that long period with no increase was quite extraordinary. As are the comparisons with other OECD countries, where for certain types, at least, of out of work families, we have a very ungenerous system. and then quite a lot of really important specific issues, particularly around the minimum income floor and the local housing allowance. I thought, Stephen, your description of active discussions between DWP and Treasury is something that we all will remember. We know exactly what that means. That was an argument between departments and ministers, one lot wanting more money and the other lot not wanting to give it out. We've got a couple of questions on Slido, but please do come up with more. We've got a couple particularly on the benefit cap, which is an interesting point. How do the changes relate to the benefit cap? How do they interact? And I think Tom, one of the things that is clear is the benefit cap is biting on a lot more people now than it did before.
Yeah, that's right. So we've seen a significant increase in the number of people affected by the benefit cap. So for those of you who don't know, the way the benefit cap works is the government limits the total amount of benefits you can get, depending on whether or not you live in London and your family type, kind of regardless of how much you might otherwise be entitled to. So you generally you get more in virtue of having more children or having high rent, for example, but then there's an overall cap placed on that, at least for a lot of families. And so because of these increases in the size of the system and because of the number more people on universal credit, we've seen a pretty substantial increase in the number of people affected by the benefit cap. And I think the way I think about it is, well, the benefit cap kind of represents a bit of a shift away in the benefit system, determining your entitlements on the basis of your needs. So before the benefit cap and before some other changes as well, as I say, you would get more if you had more children, you get more if you had higher rent, and so on. And the benefit cap essentially puts a limit on that. If you have loads of children and very high rent, then you don't kind of get more in virtue of those needs. And so that does mean that particularly for those families who do have quite high needs because of these sorts of things, then they're particularly affected by the cap and don't gain from these temporary giveaways.
Stephen, have you looked at the issue of the benefit cap as part of your committee's work?
Yes, we have. I mean, we asked the department about this at the start of the pandemic, and why was it that they were increasing the LHA, they were increasing universal credit, but not doing anything at all about the level of the benefit cap? And they said, well, they thought actually only a very small number of people would be newly affected by the cap with these arrangements. We were puzzled about that, but that's what they told us. As we know, in fact, the number of people affected by the benefit cap has doubled. And I've been looking this morning at the situation of one of my constituents who, thanks to the higher rate of LHA it's been provided, is entitled to £1,700 per month in support for housing costs. But the benefit cap for her and her family is set at £1,715 per month. So it's got £15 a week to live on. So the only way they can survive is by applying to the local council for a discretionary housing payment. And I imagine she'll get that, but DHP is a pretty uncertain means of getting support, and just shifting the costs onto councils isn't really solving the problem anyway. So I think something, if you're going to increase the rate of benefit, you need to do something about the benefit cap as well.
I think there's another one here, I think probably mostly aimed at you, Stephen, given you what you said about the 5-week wait. And I mean, I wonder whether you could say a little bit more about your concerns there. The way this is expressed in the question is this an issue of liquidity rather than adequacy? So I guess the question is really saying, is this a problem for is this just a temporary problem for people that they could overcome if they had access to a little bit of savings or borrowing, or is it a fundamental issue of adequacy in the system?
Well, certainly if people had savings, then they would be able to weather the 5-week wait. But the evidence is that lots and lots of people claiming universal credit don't have any savings at all. I think the evidence is that over half of the people claiming universal credit are weekly paid rather than monthly. It's kind of been designed on the basis that somebody claiming universal credit has actually just left a monthly paid job. So they've got a monthly, 1 month's pay in the bank before they claim. But the evidence is that most people claiming universal credit are not in that situation at all. So the department's response to this was to promote the availability of advances, to provide that liquidity, to get people through that first month. But then the advance gets subtracted from your benefit payments in the 12 months that follow. And given for the £20 increase, it was a pretty meagre level of benefit anyway. To take your advance out of monthly payments for the following 12 months meant you had a terribly low. So what the evidence is that where universal credit has been in place with these arrangements, people are significantly more likely to have to go to a food bank than people who were on the previous benefit system. Also, people are much more likely to have to go behind with their rent because they were coping with this advance repayment and the difficulties around universal credit. So I think there is a serious flaw in the way universal credit has been put together, as evidenced by the rent arrears statistics and the food bank statistics as well. The National Audit Office told us that the Trussell Trust, the food bank organisation, has established a relationship between universal credit rollout on the one hand and food bank demand on the other. Not established causation, but it has established an association, and I think that does highlight a problem with the way universal credit has been set up.
Great, thank you. Oh, Tom. So were you trying to say something, Tom?
Oh, no, I wasn't. No, I think that was just a bit of
I thought I heard something. There's a couple of questions here about the issue of incentives that Pascal raised. One essentially saying, you know, if they are weakened by if incentives are weakened by the £20 increase, isn't that just reversing the improvement of incentives, as it were, which we've had following cuts and freezes? And in any case, another questioner asks, is there any evidence of issues around incentives, and in particular, if there's no work available? Tom or Pascal, would you like to take that one first?
Yeah, I can give it a go. So basically, as I said, for work incentives become much more important, you know, when the economy is strong and there are jobs available. So I did mention that you know, the government needs to keep an eye on how the crisis is evolving and how many jobs are available, etc. What we do know is, though, that the work incentive, or the weakening of work incentives through the increase of the standard allowance, will affect mainly lower middle income families. So, and that's because higher income families are, first of all, less likely to be on UC, but also have higher amounts of income otherwise. And on the other end of the spectrum, very low income households or families will tend to be out of work regardless. But yeah, I think it's definitely important now to think about how the economy is doing, and whether because that's what matters when thinking about work incentives and how important they are.
Stephen, you've I mean, you made clear your view that you think the increases should be maintained. I mean, you're not terribly worried about this issue of incentives if the system is in some sense too generous for those who are out of work?
Well, I mean, the levels of benefit have been for several years completely frozen, and the level of benefit payments have taken a big hit from the kind of decade of austerity that we went through. And for me, the £20 a week increase is really a kind of catch up to try and make the system get somewhere close to offering a tolerable level of security. So I mean, I do take the point about incentives, but it does look for the next year or two at least as though we're going to have a really serious level and high level of unemployment, and we are going to have to provide support for families to get through that without excessive hardship. And I think taking £20 a week away would inflict too much hardship on too many people.
Stephen, I'm going to come back to you again, I'm afraid. There's a question here, something I confess I'd only realised relatively recently, which is around the fact that this £1,000 increase applies to universal credit, but it doesn't apply to legacy benefits, of which, of course, very many people are still receiving. I mean, do you think that's sort of fair and sustainable? That this
No, I don't. In fact, the committee's report in June called on the government to apply the increase to those legacy benefits as well, to job seekers allowance, to employment and support allowance. The government at the time said it hadn't been able to do that because it took them about 6 months to change the computer systems to increase the level. And of course, if they had announced in March that they were going to increase them in 6 months' time, then the increase would take effect round about now, but they haven't done so. Clearly, if the £20 a week increase is going to carry on beyond April in universal credit, then the case for it to be applied to those legacy benefits, I think, becomes stronger. And it does seem a pretty unsatisfactory feature of the system that the amount of support you get depends on the historical accident of which benefit you happen to be receiving, not on your circumstances. So I think there is a very strong case for applying it to the legacy benefits as well.
Thank you. I'm gonna finish with one last question, which I'll initially send in Tom's direction. The question is really we've got this £20 uplift, but if you have the same amount of money available, is that the best way of spending it, or would you instead increase the work allowance or cut the taper rate? I know that's something that that you've looked at quite a lot, because you can just increase the base amount in universal credit, but you could use the same amount of money to allow people to earn more before they start losing benefit, or to reduce the rate at which they lose benefit. How would you think about that trade-off, Tom?
Yeah, so I think trade-off is exactly the right word. I don't think there's there's not a right answer, at least not from economics alone. There's not a right or wrong answer here. The way I think about it is, when you're increasing the basic allowance, which is what the government did, you're helping essentially any family on UC gets the same increase, and so that's a larger proportional increase for those who are out of work, as Pascal mentioned in her presentation. But that does have the downside that it slightly weakens work incentives. Whereas when you do something like increasing the work allowance or reducing the taper rate, that only benefits families who are in work, and so you strengthen work incentives. But I guess particularly in the context of the pandemic, when there's lots of families who are out of work who are going to potentially struggle to get back into work, that might be, you might be more inclined to increase out of work benefits than you would when there's a really healthy economy and there's loads of vacancies and so on. And so I think that connects to the point Pascal was making earlier, that it's that the health of the healthier the economy is, the more worried you ought to be about work incentives. And so exactly what the next 6 months or a year holds for the labour market is anybody's guess. But as we see that unfolding, I think that's something the government should definitely be keeping in mind. If things actually start to look a lot better, then that should tilt them more towards thinking about work incentives. If things still look really difficult, really few vacancies and so on, then work incentives don't look as as important.
We're pretty much at the end of our allotted time, but Stephen, if it's okay, I'm going to give you the last word. And in particular, if you could reflect on a couple of questions here about whether the government could be doing more to make welfare information and support more accessible during this crisis, and perhaps particularly in the context of it seems at least possible that there are a number of, or rather more middle-income families than usual. People are unexpectedly unemployed. I don't know whether you've had experience through the committee or through your own casework of people struggling to access the system, people who have not been familiar with it, or people who are accessing it who really never expected to be, and whether you think that has any impact on how government should respond, or indeed how we might think of the welfare system going forward.
Yes, well, I think it's worth making the point that the universal credit system has stood up pretty well in this pandemic. There were hundreds of thousands of new applications, I think over 100,000 on one day in March for universal credit, and the system didn't fall over. And I think it's done well. It's handled that very large number of applications, done so reasonably efficiently, not kept people waiting too long. It's provided a lot of urgently needed support pretty efficiently. And I've been a long-term critic of the way the DWP has implemented universal credit, but I have to say the system as it currently stands, I think, has done well. There have been problems with people understanding the system. And perhaps the most glaring one has been quite a lot of people who were on tax credits, saw all the publicity about universal credit, applied for universal credit, didn't realize that meant they were going to lose their tax credits. In some cases, these were people who had more than £16,000 in savings, so they weren't able to get any universal credit at all, but they'd lost their tax credits, and they're not allowed to go back to tax credits having gone on to universal credit. So there were some problems of that kind with the information. I think there is evidence that better off people have applied during the pandemic than was the case previously. Perhaps most strikingly, you can see that in the proportion of applicants who ask for an advance, which they then have to repay over the following year. So before the pandemic, I think around about 2/3 of universal credit applicants were asking for an advance when they applied. Since March, it's been only about half of that, which presumably is because a much larger proportion of those applying have got some sort of savings to fall back on and to tide them over. So the system has done, I think, a good job for us over the last 6 months, but there are undoubtedly some lessons to be learned from the experience, which I hope will be applied in the months ahead.
Great. Well, thank you very much. We're already 5 minutes over our allotted time, so I think we should probably draw it to a close there. Thank you to everyone who's been listening, and for the questions that have been sent through. I think the lesson of this is send the questions in early, because they trickled in and then came in a bit of a flood later on. Thanks ever so much to Pascal for the presentation. Thank you, Stephen, for joining us, and Tom as well. Hope to see you all again soon, hopefully for the launch of our main Green Budget on Tuesday morning. Thank you very much.